Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, the regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me for this segment, we have Kurt Daum, Senior Portfolio Manager at Victory Income Investors, a Victory Capital investment franchise, as well as Mike Sanders, Head of Fixed Income at Madison Investments. We're here to discuss fixed income positioning in today's environment and outlook for credit and historically tight credit spreads. Gentlemen, it's great to have the both of you with us. And before we get into positioning and what you're seeing in terms of tight spreads, what's the latest with the economic data, Kurt? What's really sticking out to you? It seems to be that the Fed is not getting what they need yet in terms of revising their interest rate policy.
Well, I think that's correct. I think we're seeing a couple of things. One, we're seeing kind of a slowdown in almost everything almost all of the data that we're seeing a slowdown. So PMI, all of the data last week led us to believe that things were slowing. And then we get the jobs number, right? Then we get the jobs number on Friday, and it still shows a strong, resilient job economy, and it still shows strong, resilient employment across the board. And that's where I think the Fed, that's this conundrum that the Fed has is, right, you've seen some signs of weakness, which leads us to believe that, and leads the rest of the world to start to cut, yet there's still strength in inflation, there's still strong inflation, and there's still strength in overall jobs. And I think that's the needle that the Fed is going to have to thread. And that's a lot of the risks that we see kind of in the fixed income market today.
Yeah. And Mike, it's interesting. Some of this data that's coming out, it can be conflicting at times. There's something for everyone within it. Some parts of it are good, some parts are not so great. And I think that's also part of the challenge that the Fed is dealing with, finding balance within the data that they're dependent on.
Yeah, absolutely. And I would agree with Kurt that it's mixed data across the board. Even with the jobs release last week, you had the unemployment rate tick up a little bit, and you had a big beat on the claims on the overall number. And so, there is something for everybody, and you can pick and choose the data point you want to justify your narrative. But I think from a holistic standpoint, the market is pricing in, I think a little bit higher inflation going forward than what the Fed really wants. And, probably a pretty low probability right now of a recession. And I think credit spreads, not to jump ahead of anything, but I think credit spreads and risk assets aren't really pricing in any sort of possibility of maybe a downturn that could kind of adjust values.
Right. But Mike, we'll get to that in just a moment here, but I want to think about it from the consumer perspective as well, because the economy really has been predicated on the strength of the consumer, whether it's spending in discretionary items, we're seeing some pullback there, but services certainly. But it feels as if, well, the market is interpreting what's happening with this type of data very differently than the way consumers feel it. They still see and hear, prices prior to COVID up 19 to 25% in many areas of the economy. So it feels as if there's this bifurcation here in terms of what the data is saying and then how it's actually perceived on the street.
Yeah, I think it does matter also which consumer you're talking about. I think the consumers that own stocks and are probably at the higher level of income, I think feel it a little bit less. I think the middle and lower tiers of the income stream are having a bigger impact because they feel that inflation, that level reset in terms of where we see inflation before COVID and after COVID, and that's going to hurt them a lot more when it comes to purchasing power.
Right.
I love the way that Mike framed that. I love the way that Mike framed that, right? Because so many people want to bucket the consumer into the high-end consumer and the low-end consumer. And really, we're seeing weakness beyond that in the consumer. It really is the high-end consumer. So people that are able to take advantage of 5% money market rates, people able to take advantage of the stock market at the very top end, things are going great. But the rest of the consumer, and it's not this mythical, hey, there's, the median wage is 78,000 and anybody below that is bad and anybody above that is doing fine. It really is the middle class and the lower class. It really is a much broader swath that really we think is struggling, and inflation and interest rates are really having a burden on a lot more than just the median high versus low end consumer.
Right. And Kurt, that's a great point that both of you make. But I also feel like if we get back to the Fed for a moment here in terms of them determining their policy, look how well the market's done. We're sitting at virtually all-time highs. We didn't get those 6 to 7 rate cuts that were expected at the end of 2023, but the market has been digesting other fundamental factors really well. Balance sheets are performing quite well, even in a higher inflationary environment for the most part. But if we were to get any type of, rate cuts beyond, let's even call it 2 for 3 for this year, which I personally don't think is the case, then that's a signal that there are some stresses in the economy. So it's kind of a double-edged sword there when you want to be careful for, wishing what you want.
I completely agree. And I think the concept of a soft landing and this mythical soft landing, we like to, Sully landing the plane on the middle of the Hudson just perfectly. It doesn't happen, right? It doesn't happen all the time. It's much more likely that something will break, to your point, and we will have softness and we will have a recession, so that the higher rates stay for longer, the much more likely we are to have not this mythical soft landing where things just glide to a smooth path, where things really do slow down.
Yeah. Mike, do you think that with the Bank of Canada and the ECB cutting, do you think that's going to have any influence on the Fed at all?
Not really. I mean, there might be some flow differences in terms of maybe demand for certain parts of the US market, but I don't think the Fed really cares what the Bank of Canada or any other central bank really does. They're more focused on what's driving their domestic policies. And, inflation is running too high. I mean, however you want to measure it, average hourly earnings are well above where we saw in 2019 to 2009. Services inflation, you could strip out the housing part of it, you can strip out the insurance side of it, all these one-off adjustments, but every single print, it seems to be that there's one item that seems to be driving it at any one point in time. So I don't think the Fed really cares. They're more concerned on what's going on here. And right now, inflation is not where the Fed needs it. And that's has to be concerning. The higher they keep rates to fight this inflation, to Kurt's point, the odds go up a little bit more that you're going to have probably not this soft landing that I think in some respect the Fed thought they had achieved in the back half of last year. And it's a little more uncertain now, especially now given that the market's at 1 cut, 1.5, depending how you want to look at it, through the back half of the year. And in reality, I think it matters from our perspective, not so much when they cut, it's of how many times they have to cut. If the economy is doing okay with rates where they are, the thought that the Fed is going to have to cut interest rates back to where they think the dots say, which is 2.5% long-term Fed funds rate, I just really don't see that. We think that's going to be a higher level. And if it turns out that they have to cut more, it's probably not for very good reasons. And that's going to have a big impact on different parts of the market.
Yeah. So then that suggests that the concern is for the longer end of the yield curve.
Correct. Yeah. I mean, if the Fed only has to go to a 4% Fed funds, let's say, is fair value on 30-year treasuries, 4.5% or whatever it is right now. I mean, probably not. It's probably going to be a little bit higher number than that. And, it's going to cause a bigger impact. And, different parts of the market are priced differently. And you think about where, spreads are in terms of long end corporate bonds, you're buying an expensive part of the market with a lot of uncertainty out the curve.
Yeah. So Kurt, when we talk about tightening spreads here, right, what does that signal to the overall market?
Well, I think it signals a couple of things. One is it signals that the market thinks, just like in 2020, that the Fed has everyone's back, right? And so I think part of the reason why spreads are so tight, yields are attractive, spreads are tight, because what the Fed did in March of 2020. In our opinion, they're way too tight, right? They're signaling the market that we will have this soft landing. It doesn't seem right? We think that there's a significant opportunity for spreads to widen here. Maybe not a lot, but definitely, corporate credit spreads are at 89 basis points on the corporate credit index. Spreads are very tight. We don't think that they can sustain this tight level with the slowdown that we're seeing for long.
Right. So then, Kurt, from an investment perspective, when you're thinking about your fixed income portfolio, how would you be positioned in this type of environment?
So, we think that income is what ultimately drives returns over time. So you have to have some spread product. You have to own spread product. That being said, as we hold less spread product than we would typically hold. We think owning treasuries, owning agency mortgages are attractive today. Other fixed income asset classes, such as structured product, taxable municipals, look attractive, especially relative to corporate credit, which can default or which can get downgraded over time and just have deteriorating performance.
Mike, do you think investors are overexposed to credit at this point?
I think it depends on what credit they're exposed to. I think investors have reached for yield, like low end triple B spreads, high yield, to Kurt's point, you haven't it's been less than 10% of the time over the last 25 years that they've ever been tighter. And they can stay tight for sure. But if you think about the distribution of possible future moves, most likely it's going to be wider, right? I mean, you're not getting paid enough for that. So, I do think that investors are probably reaching a little bit. Think about even, private credit and these other parts of the market where they're trying to reach to kind of squeeze out a couple of extra basis points, maybe take some risks that they're not really thinking about. But I do think there's other areas that, are okay in terms of valuation. I think bank paper in general, attractive relative to industrial bonds, right? I mean, spreads are a little bit wider and, you could have volatility, but, owning a JP Morgan, a Bank of America, those kind of names, solid, obviously very solid credits. They offer a little bit more spread than maybe the industrial space. And so I think there's value there. But I would agree with Kurt as well on the structured product, agency mortgages. You've had the Fed not buying as many, obviously now. And then you've also had this impact from the banking industry and all the issues that they're having. And you have this huge difference between what the Fed has owned in terms of low coupon, 3.5% and less mostly, and what's getting issued now, which is 5.5, 6.5 type mortgages. And from our perspective, there's much more value in the higher coupons than there are in terms of the lower coupon stuff. And that's why, you really hire fixed income managers, to kind of figure out, well, what's good and what's bad and what makes more sense in this kind of environment. And we think that like the agency mortgages and parts of the bank market make a lot of sense.
Right. So Kurt, it kind of sounds like higher quality is what I'm getting out of you and Mike.
100%. I think that investors aren't being compensated to take down in quality, down in credit quality risk. As Mike mentioned, high yield doesn't look particularly attractive right now. High quality, high yield, right? Staying up in quality, finding those high quality corporate credits and finding those high quality structured products and just waiting for a more opportune time because the dispersion of spreads isn't significant. All spreads have compressed and just waiting and being patient is the right way to play it.
All right, gentlemen, appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.